Finance can be a confusing space. Alpha, beta, delta, vega, theta. It's like having to learn a completely different language. But these concepts can really accelerate your financial literacy and take your finance knowledge to the next level. Welcome back to the Industry Portal's Finance Explainer series, where learning finance is made simple. In this video, we're talking about a concept that's crucial for understanding risk in investing. And that concept is beta. Now, if you've ever heard someone say, this stock has a high beta, or this portfolio is low beta, and wondered what it means, don't worry. By the end of this video, you'll know exactly what beta is, how to calculate it, and why it's such an important tool for investors. So let's dive in. So what is beta? Well, beta is a measure of a stock's volatility, or how much it moves compared to the overall market. So think of it as a way to understand how risky or stable an investment is relative to the market. Here's how it works. A beta of 1 means the stock moves exactly with the market. If the market goes up 10%, the stock also goes up 10%. If the market drops 10%, so does the stock. A beta of greater than 1 means the stock is more volatile than the market. For example, a beta of 1.5 means the stock is 50% more volatile than the market. So if the market goes up 10%, the stock might go up 15%. If the market drops 10%, the stock might drop 15%. And a beta of less than 1 means the stock is less volatile than the market. For example, a beta of 0.5 means the stock moves only half as much as the market. So if the market goes up by 10%, the stock might only go up 5%. Now, beta helps investors understand how much risk they're taking on when they invest in a stock. A high beta stock might offer bigger returns, but it also comes with more risk. A low beta stock is safer, but the returns might be smaller. So let's break this down with an example. Imagine you're choosing between two stocks. Stock A has a beta of 0.8 and stock B has a beta of 1.5. If the market goes up 10%, stock A might rise by only 8% because it's less volatile, while stock B could jump 15% because it's more volatile. That sounds great, but here's the flip side. If the market drops 10%, stock A would only fall 8%, but stock B could drop a whopping 15%. This is the risk-return trade-off in action. Beta gives you a way to measure how much risk you're taking relative to the market. So how do we calculate beta? Well, beta is calculated by comparing the returns of a stock to the returns of the market over a specific period. Without diving too deep into the math, beta is essentially the slope of the line when you plot a stock's returns against the market's returns. The steeper the slope, the higher the beta. But here's the good news. You don't have to calculate beta manually. Most financial websites and tools like Yahoo Finance or Bloomberg will list the beta for a stock. So why is beta important for investors? Well, firstly, beta helps you build a portfolio that matches your risk tolerance. If you're a conservative investor, you might prefer low beta stocks that are more stable. If you're a risk taker, higher beta stocks might be your style. Secondly, beta is a key component of the capital asset pricing model, which we talked about in a previous Finance Explainer video. CAPM uses beta to calculate the expected return of an investment. In other words, beta helps you decide if the potential reward of a stock is worth the risk. And thirdly, beta is useful for diversification. By mixing high beta and low beta stocks in your portfolio, you can balance risk and return. For example, pairing a high beta tech stock with a low beta utility stock can help smooth out your portfolio's overall volatility. But here's something important to keep in mind. Beta only measures systematic risk, which is the risk that comes from the market as a whole. It doesn't account for unsystematic risk, or what is also known as idiosyncratic risk, which is risk specific to a company, like management changes or product failures. That's why diversification is so important. It helps you manage both types of risk. So with that said, let's recap. Beta is a measure of a stock's volatility relative to the market. A beta of 1 means the stock moves with the market, greater than 1 means it's more volatile, and less than 1 means it's less volatile. Beta helps investors understand risk and volatility, build portfolios that match their risk tolerance, and calculate expected returns using models like CAPM. And that's it, Beta explained simply. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out theindustryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.